We're so glad you've decided to join us. Let's begin by talking about users and their needs. Every accounting textbook starts here, and for good reason. It's important to understand who's relying on financial information and for what purpose. While your role may be as an owner, executive, or director, understanding how other users make their decisions based on financial information is a necessary element of financial intelligence. As an owner, executive, or director, you're likely using financial information to track performance, to manage or monitor spending, to evaluate a request for more resources, to set incentive compensation, or to make an investment or financing decision. The key questions for you to ask are, first of all, do you have access to the right financial information? Secondly, is that information credible? And thirdly, is that information timely enough to help you make decisions to manage and guide the business? If they're not, you need to have a conversation with the right people to get what you need. As an owner or a director appointed to act on behalf of the owners of the business, you're a key user of financial information. The financial side of the business is its lifeblood. In a for-profit company, owners of the business are the shareholders. Shareholders buy one or more shares of a business by contributing capital or money to get the business going. Some companies have one founding shareholder. Others, such as large public companies, may have tens of thousands of shareholders. Shareholders don't have a direct say in how the business is operated. Their interest in financial information is limited to the decisions as to whether to buy, hold, or sell their shares. However, one of the few rights shareholders have is to appoint a slate of directors to the board of directors. A director may be a shareholder. Sometimes senior managers are appointed directors. Directors may be entirely independent of shareholders and management and serve in an open-minded, impartial basis. The board of directors acts on behalf of all stakeholders, prime among them the shareholders who appoint them. But the directors also have a fiduciary responsibility to lenders and employees as well. As a director, you have full access to the financial statements of the business. However, financial statements do not always present the full picture of what is going on inside the organization. Those providing financial information may or may not provide a commentary to help you out in your understanding. A public company will release what is called a management discussion and analysis, or an MD&A. This reviews the financial results of the business through the eyes of management. This is important for you as an owner or a director to get this perspective. It's important to note that if you're not provided with commentary or analysis that helps you understand the financial performance to your satisfaction, that you're not only within your rights, it's your fiduciary responsibility to ask management to provide you with additional information to help you satisfy yourself that what has been represented in the financial statements is in fact accurate. The owners and the directors of any organization control the purse strings. They decide whether the business is to grow through reinvestment or acquisition, or alternatively, when they lose faith, decide whether it's time to sell or close the business. This is accomplished by the board approving decisions related to capital allocation. Owners and directors fundamentally get to make or influence 10 types of decisions that concern how an organization sources cash and deploys it. Think of these as levers that owners and directors can pull. The challenge is knowing which of the 10 levers to pull at any given point in time. There are essentially 5 levers you can pull for sourcing cash. Optimizing cash generated from operations by making any decisions that cut costs or alternatively grow revenues. Optimizing cash invested in working capital by changing credit terms with customers, reducing the amount of inventory you carry, or by stretching payments to suppliers. Making a decision to sell one or more parts of the business to raise cash, raising cash from issuance of new debt from lenders, and finally, raising cash from issuance of new equity from shareholders. There are generally 5 levers you can pull to deploy cash as well. First of all, you can reinvest in existing operations by buying new equipment, or by opening up new locations, or by investing in new technologies. Secondly, you can acquire another business. Thirdly, you can pay down your debt. Fourthly, you can pay a dividend to shareholders if you're a for-profit enterprise. Or finally, you can repurchase equity, again, if you're a for-profit enterprise. Managing the financial health of any organization boils down to these 10 decisions. And to make these decisions, you'll need to understand how the organization is performing, both operationally and financially. This evaluation and the decisions that ensue are the crux of your financial intelligence. Let's move on to talk about banks and lenders as our next group of users of financial information. As a non-finance executive, owner, or director, you typically won't deal with the bankers and the lenders directly. This is often undertaken by your chief financial officer or your chief executive officer. However, many entrepreneurs find themselves unwittingly in front of bankers trying to raise capital to get their business launched. Banks and lenders make decisions on whether to extend you a loan, call existing loans that they may have outstanding. Also, lenders make determinations about the terms of any loans. The terms of a loan vary in size and cost and duration, in covenants, which are the factors that you have to make sure you comply with or else they can call the loan, in oversight, among a whole host of factors. Not every idea is fundable. So if you need capital, working with your finance team can help you identify the best sources of financing. There are many variations of lending agreements to consider. Short-term needs for financing can help you cover your expenses while you await collection of money owed to you by customers, known as accounts receivable, or inventory you need to have on hand to meet sales. These needs can be financed with short-term sources of financing, like a line of credit. Long-term needs for financing might include the purchase of a building or equipment. These needs are often met using term loans, leases, and mortgages. Which is to say, just like the mortgage on your house, it's a loan that gets paid off over a longer period of time. Banks and lenders are interested in two things before they'll provide you with a loan. First of all, the organization must be able to repay the loan. So they will be looking at the cash flow that the business generates and ensuring there is a comfortable margin of safety to service the debt. That means that not only can you pay the debt back, but that you have enough extra cushion room in there for all the other expenses in the business. Secondly, banks and lenders will want to be secured. Security means that in the event the business does not repay, the lender can take the security and liquidate it to get their money back. Security is the hard assets of your business. In other words, those IOUs from customers, your inventory, your property, your equipment. If you don't have both number one and number two, getting money from banks is very difficult, in which case you'll need to look to the owners to fund any cash requirements. In our next lesson, we're going to talk about where information comes from.